Good afternoon.
Welcome, everybody.
This is David Dietze, and I have with me Claire Toth. We are of Point View Wealth Management, coming to you live from Summit, New Jersey. We are delighted to be with you all this afternoon because we think we have kind of an interesting topic that can really make a difference in your bottom line for all you retirees or retirement savers. I am joined by Claire Toth today. Claire has been a tax attorney for over 30 years. She heads up our financial planning department. She holds multiple degrees from the University of Chicago, plus a master's in taxation from Georgetown. Indeed, spent 11 years at the Department of Treasury, plus many years in private practice. We've been working together here for close to 20 years. Let me turn the page here, the next slide. Before we get into the meat of our presentation today, people say, well, who is Point View and why Point View? Well, we are independent, fee-only investment advisors. We are registered with the Securities and Exchange Commission, which means we must adhere to the highest fiduciary standards in the land, always putting the client first, not a suitability standard as may govern many brokers that you may run across. We are fee-only, which means we only charge clients one fee, a flat 1% per year on assets under management. What does that mean we don't do? It means we don't charge commissions. We don't charge back-end fees, hidden fees, or any other types of fees which do not completely, in our view, align our interests with the client. What do? Basically two things. One is customized investment management. We manage portfolios for the particular needs, the particular goals, objectives, etc., of each different client. No two clients are the same. One size does not fit all. Plus, we provide holistic financial planning. We try and figure out always the big number. When can you retire? And if you are in retirement, how much can you take out each year? How much can you leave your heirs? How much can you give to charity, and how to do it in a tax-effective way? How can you plan for your kids or your grandkids' college education in the most tax-advantaged way possible? There's a myriad of financial planning topics we help all of our clients with. We're all about not just solid investment returns, but tax efficiency and, of course, transparency. What do we mean by transparency? Most of the competition is using mutual funds. We're going right to what the mutual funds own themselves, actual stocks and bonds, so that you can see what you have. You avoid duplication. You avoid a whole nother set of fees. You control your taxes. Who can we do this for? Because it's so customized, we have to have a minimum size relationship. That would be $500,000. For that 1% management fee, you get the investment management, you get the unlimited financial planning, and you sidestep all the underlying fees of the funds and ETFs that are often used by the competition. We do have another program where for one flat fee, we can do what my partner Claire Toth calls is the equivalent of a financial colonoscopy, the deep dive, looking at your investments, looking at every part of your financial life, coming up with a game plan. We deliver that to you, then you can go in one of two different directions. You can execute yourself, or you could ask us to help you with all or a portion of it. Should you do the latter, the investment management fee is credited dollar for dollar against what you paid as a advisory fee. Most important of all, we don't hold your assets. They're all held by one of the largest, most prestigious financial custodians on the planet. That would be Fidelity Investments, so that you have asset security at all time. Claire and I don't do this alone. We're so lucky to have at least 7 other members of our team. You can see them there in our picture, including 3 portfolio managers and 4 members of our client service team, including a marketing specialist. We've been doing this for over 25 years. Along the way, we are humbled to have been recognized by many prestigious institutions. CNBC has ranked us among the top 100 in the entire country in terms of independent fee-only wealth managers. And just last year, we were lucky enough to be recognized by the Financial Advisor magazine as one of the top registered investment advisors in the country. Now, I'm going to turn it over to Claire to start the discussion here.
Okay, let's get into the meat of this. It's important to step back and realize that all of the assets you own, whether they're your individual accounts, your workplace retirement plans, what you save for your children's education, all of that should be managed as a single whole rather than individual silos. So you should have one big asset allocation plan and then divide your holdings up among your various accounts in the most tax efficient way. And this chart is kind of the big picture. We're going to do a deep dive into a lot of pieces of this. But we believe that you should focus your stocks, your equities in your taxable accounts and your fixed income in your retirement accounts. There are some tweaks in there for Roth IRAs, for 529 college savings plans, and for an IRA you inherit from a non-spouse, an inherited IRA, say from a parent or a sibling. And each of them has slightly different characteristics that you should think about when you're deciding which assets go in which account. So with that as an introduction, I'm going to turn it back to David, who's going to talk about some of the investment characteristics of fixed income.
Thank you, Claire. So, many people say, well, I get this asset allocation, but why allocate to bonds at all? I mean, over the last 10 years, we've seen the Dow go up on average 16% per year, while short duration, short maturity taxable bonds up less than 2%. Well, why bonds? Well, here's the thing. No one has a crystal ball as to the future. So the trick to reach your goals with the least risk possible is to diversify. And that diversification starts right at the top with the asset classes you're using. What's an asset class? It's a group like stocks or bonds or cash, which has very similar characteristics. So we always start with our clients in trying to develop an asset allocation that makes sense. The more you tilt to stocks, the more volatility you're going to have, the more risk you're going to have. We saw that the first couple of days of this week, but potentially the greater returns. But guess what? You still have to get through that volatility to get to that other side, enjoy those returns. And no one can tell you for sure that over any period of time, stocks will always outperform bonds. So you want to have fixed income, bonds and fixed income, same thing, in order to cushion volatility and hedge that stocks are poor performers. This by cushioning volatility, it enhances your ability to stay the course. You're less freaked out, as they say, when that market gets very, very volatile. And of course, one of the keys for the best risk-adjusted returns is to have that balance and periodically check to make sure you're within balance. And if stocks have underperformed, bonds gives you so-called dry powder, a source of funds to reestablish that proper balance and add to stocks when they are down, and of course, vice versa. Of course, bonds generally, in terms of the interest they pay out, provide a superior return to cash.
And even beyond some of the volatility dampening aspects of bonds, bear in mind that when we're developing an asset plan for any client, when you're looking at it for yourself, stocks may in fact do have a higher long-term rate of return, but you may not need to reach that high annualized rate of return in order to meet your financial goals. So why take on more risk than you need to achieve your ends when having some bonds in the mix can allow you to reach the goals you want and still sleep at night?
Great. And this chart here gives you a visual representation of the fact that when stocks have a rainy day, which is a euphemism for having a negative return in any year, bonds are likely, now these are high quality bonds, are likely to have a return, a positive return that same year. Why is that? Because typically when investors are fleeing stocks, where are they going? They tend to go to high quality fixed income as a safe port in the storm. And so this chart shows you various bear market years going back to 1929, and you can see stocks being blue when they're below that horizontal line, they're reflecting a negative return for the year. And you see the green is bonds invariably enjoying a positive return. Why do you benefit? Because a properly diversified and allocated portfolio will have a mix of those two returns, and therefore you're not suffering that really negative bear market return 100% with your portfolio.
Okay. So the big problem with most bonds that we think of, bonds issued by corporations, bonds issued by the federal government, by government agencies, is that the interest on them is fully taxable. This is also the case for interest you earn at your bank on CDs and money market funds. And when we say fully taxable, it's ordinary income. It's taxed to you at whatever your maximum tax rate is. For instance, if you're making $500,000, a married couple, your maximum tax rate is about 37%. So that's the interest rate you're paying on taxable bonds. And contrast that to the tax rate you would be paying on qualified stock dividends and on capital gains, which is, depending on your taxable income level, is either 15% or 20% at the federal level. And in some cases, it can even be 0. And that's a big driver, which we'll get to in a moment, of why your fixed income ought to be in an account where you're not currently paying tax.
Thank you, Claire.
Okay. Mm-hmm.
So some people say, gee, you're all worried about bonds attracting high rates of tax in a taxable account. Why not just buy tax-exempt bonds? Of course, by their definition, bonds paying tax-exempt interest, you're not paying any taxes on that interest. So is that a solution? Well, yes and no. I mean, here's the big problem why we don't generally recommend that is tax-exempt bonds, since the interest is not subject to tax, have a much lower interest rate. Why would that be? Because an investor seeing one bond where there's no tax on the interest, another bond where there is, what are they going to choose? They're going to choose the tax-exempt bond. So the price goes up, the interest rate goes down, and so what you're saving by not paying taxes, you lose because you get less interest. So that makes tax-exempt bonds a very imperfect solution in terms of where you put your bonds and why you might still put them in your taxable account. The other thing, of course, is it's not just federal taxes you have to be concerned with, it's state taxes too. So unless your tax-exempt bond is issued from a jurisdiction in your state, you're still going to be subject to state sales taxes, which can be quite high in many of the coastal states, including New York, New Jersey, and California, and as we all know, are less deductible, severely less deductible against our federal tax than it used to be, so the burden cannot be minimized. Of course, another problem with municipal bonds is your credit quality may be not as good as a taxable bond. Certainly, if you're trying to compare a bond from a state or from a city against, let's say, an obligation from the United States government, it's a dicier proposition. That would probably also make them inferior to bonds issued by agencies of the federal government. And of course, another problem with tax-exempt bonds is the liquidity generally is less. Quite frankly, there's less held out there, there's less in circulation. So when it comes time to sell, your costs in terms of a potential bid-ask spread, or indeed even finding someone else to be on the other side of the trade, may be significantly more costly and more challenging than a taxable bonds. So those are some of the reasons where we don't think tax-exempt bonds are the best way to go for people in terms of the bond portion of their account. Claire, back to you.
Okay. Now that we're in agreement, you need some bonds. You really prefer to have taxable bonds. And as I had mentioned, the stocks are tax favored. This is why we want people to put their bonds in their tax sheltered accounts and their stocks in their taxable accounts. So first, let's define the different kinds of accounts. There are tax sheltered accounts, which I think of as most employee retirement plans and IRAs. There are also tax exempt accounts. In a tax deferred account, like your standard 401k or IRA, you don't have to pay tax today, whatever happens in the account. You do have to start taking money out when you turn 70. And when you take the money out, everything is taxed as ordinary income. So point one there is that even if you put tax favored stocks in your retirement accounts, when you take the money out, it's coming out as ordinary income. It does not keep that tax flavor, but you do defer the taxes until you turn 70. Tax exempt accounts are Roth IRAs and 529s, where there's no deduction on the way in, but everything grows tax-free. And if you use the money for permitted purposes, you're never going to pay tax on the gains. Then you've got your taxable accounts, which are everything else. It's the stuff that spouses own together. You may own it individually. You're going to pay tax currently on the investment income. That's the dividends, any interest, any taxable interest in the account. When you sell investments in the account, you're going to pay capital gains on those taxes or on those sales. And as I had mentioned earlier, the tax rate on stocks is less than the tax rate on bonds. Take advantage of it in the taxable account. You do have a couple of other benefits holding stocks in a taxable account that you don't have holding them in a tax deferred or a tax exempt account. As I had mentioned, if you really play your income levels right, you may avoid paying capital gains taxes at all. And if you have a capital loss in an account, because stocks don't always go up and sometimes you do sell at a loss, you can use that loss against capital gains in the account. If you've got more losses than you have gains, you can use up to $3,000 of that loss against other income. And if you still haven't used up all the loss, you can carry it forward to subsequent years, rinse and repeat. Use it against capital gains, use up to $3,000 in addition against other income until you've used up the entire loss. That ability is not available in a tax exempt or a tax deferred account. So for all these reasons, we think that your stocks first ought to go to taxable accounts. Now we know that if, say, you've decided the proper allocation is 60% stocks, 40% bonds, probably your accounts don't line up perfectly like that. So you're going to have some stocks that you're going to own more stocks than you have taxable account, or more bonds than you have retirement account. So how does that work? How do you want it first? Once you've allocated all your stocks to your taxable account, we think they next belong in a Roth IRA. With the Roth IRA, the expected life of a Roth IRA is probably your life expectancy, your spouse's life expectancy, and perhaps then your children's life expectancy, because you and your spouse are not required to take money out of the Roth IRA if you don't need it. Once the two of you pass away and your children inherit it, they will have to take distributions over their lifetime, but that can be decades. So because stocks are the biggest growth engine in the financial portfolio, we want them to grow as long as possible. We think the Roth IRA is a great place for them.
Claire, can I interject?
Absolutely.
Yeah. So I want to tell our audience, one thing I was remiss in terms of telling our audience right to start is two things. One is we do have a poll, and the poll asks, do you think you're on track for retirement savings? We would ask each of our listeners to just indicate, I think it's on the right on your screen, yes or no. And we will tally that and share that interesting information at the end of our program here. The other thing I want to point out is there is the ability, and we're looking forward to fielding questions from you. You can't orally indicate your questions, but I believe on the right, you can type in like a chat room type of thing, your question. No one else will see your question, but we will see it. And we look forward to addressing those questions. It can be the most interesting part of the program as soon as the regular part of our presentation is over with. With that, I'm going to give it back to Claire here.
Okay. So after the stocks are in your taxable account, then the Roth IRAs, and then we like that. Then if you still have room for stocks, they should be in the 529 accounts. Like Roth IRAs, those are tax-free forever. The difference is that a 529 is going to have a shorter life expectancy than a Roth IRA. It's for your children or your grandchildren, for college and grad school. Assuming they're reasonably on track, those accounts will be used up when the child is 25 or so. So it's not quite as long-lived as the Roth. Then we move to the retirement accounts, where we think that's where your bonds belong, so that you're not turning all the good tax consequences of stocks into ordinary income when the IRAs are forced to begin distributions. And at the very bottom of all of this is the inherited IRA. This is the IRA you inherit from a parent or a sibling. You are required to take distributions out of that IRA the year after you inherit it, and you're required to take it out at a much faster rate than you would take out of your own IRA. And for the most part, this is not an account that you're going to need to fund your own retirement. It's not your retirement money. And because it's essentially found income, we think that you don't want, that's not an account you want to grow as fast as some of the others. So that fixed income definitely belongs in that one. And we know that not the whole world doesn't quite see this our way. So David's going to explain some of the counter arguments he's heard over the years.
Yeah, absolutely. I mean, this is advice that works for a lot of clients, but every situation is unique. Some of the pushback sometimes we get on our approach of stocks in the taxable, fixed income generally in the tax sheltered is, gee, my tax sheltered accounts, I'm not going to be taken out of those until I'm 70, Roth maybe even later, and stocks have a long time horizon relative to fixed income. So why shouldn't my stocks be in the tax sheltered accounts? Well, here's the answer, I think, is, there's no question about it. You only want to buy stocks with longer term money. But that doesn't necessarily mean that your only long-term money is in your tax sheltered account. Lots of people have taxable nest eggs that have to last them to and through retirement and maybe to the next generation. So, therefore, since both types of accounts have long-term money, put the stocks in the account where you get the best tax outcome at the end of the day. The other thing is, by having, you're still going to want to have some fixed income, and there's nothing we know how to do in terms of not attracting high rates of tax in terms of your taxable accounts. And so therefore, since you're going to want to have some bonds and fixed income for the reasons we talked about earlier, if you put them in the tax sheltered accounts, that's going to give you the best tax outcome. And certainly that will give you some dry powder for the inevitable sell-off in the stock market. The next objection we hear is, I get all this, but I got my taxable account and I'm hoping to, buy a boat, buy a car. I need to make a withdrawal. I can't just lock all that up, and I'm not going to take the money out of the IRA because that's going to be subject to complete taxation when I take it out. Possibly I'm not eligible, absent penalties, to take it out until I'm 59 or more. So therefore, I can't buy stocks in the taxable account because I got that withdrawal that's coming up. So what's the answer there? Well, it's all about how big is that withdrawal going to be relative to your taxable account. Now, we have seen over financial history drawdowns. That means sell-offs in the stock market of up to 50%. So what we're really looking at is how big is the withdrawal relative to the size of the account. If the withdrawal is going to be $450,000 and you've got a $500,000 taxable account, yeah, don't invest in stocks, because if there's that 50% drawdown, you're not going to be able to make the withdrawal. But if it's $1 million account and you're talking about buying a $50,000 automobile, that should not get in the way of keeping that taxable account in stocks, because it's just 5% of the account. Now, it's true, you might have to take that 5% out when stocks are down, but by the beauty of many of the tax rules that we just reviewed, you might be able to sell a losing stock position, take a tax loss, and then later on, should you want to trade out of a stock that's done well and realize a gain, you have a loss to offset it. And I mean, the reality is, although no one can predict the future, over time, financial history shows that 2 out of 3 days, 2 out of 3 months, 2 out of 3 years, stocks normally go up. So keep that money working for you completely. If you have to sell on a down day, so be it. You took the chance that you had double the opportunity potentially to make a gain there. And then, of course, if you do have to take a withdrawal from a taxable account to sell stocks, at the same time, you can go to your IRA and rebalance some of the fixed income there into stocks. And if you believe that you're selling at a weak time in the market, take advantage of that weakness and rebalance into stocks back in those tax sheltered accounts. So we think small withdrawal from a taxable account is okay to keep the taxable account primarily in stocks.
And this goes back to where we started with, you ought to be looking at your entire portfolio as a whole that is working together, rather than as separate little silos that you have to think of separately. Because everything that you own should be working for you together. I analogize it to a crew team. You really don't want each oar off on its own.
Great. So that concludes the prepared portion of our presentation. Obviously, the slide here in front of you shows that we'd love to sit down with you, talk with you to discuss and review what you are doing, if there's any way we can help you optimize your asset allocation, how all this applies to your individual circumstance. But now we've got kind of a fun part of the presentation. We've got a number of great questions that have been submitted. I'm going to field 2 here, and then I'm going to turn it over to Claire to field 2. Yeah. First of all, someone out there has asked a good question. How safe are stock dividends today? And given that most people have the bulk of their portfolio in stocks, that is a critical question. The fact of the matter is, it's all relative. Stock dividends are not as safe as bonds, as preferred stocks, as even subordinated debt. First of all, why is that? Logically, when you look at the capital structure of a company, when money comes in, if there's any excess after paying the employees, after paying for the goods that were sold, the money first must go to the bondholders to pay for their interest. Any money left over then can go to the subordinated bondholders. And after that, it can go to the preferred stock. And only with money that's still left over then can it go to the common stockholders. So if there is a hiccup or a shortfall in the business, the stockholders are the last in line to get their dividends. And so I think that makes it clear that stock dividends are not as safe as everything else. Then the question is, are they still pretty safe? Well, I think there you really need to look at it on a company by company basis. 2 things that I would suggest people look at is the payout ratio and the type of industry involved. What's the payout ratio? The payout ratio looks how much of the net profits of the company is being used to pay the dividend. If that payout ratio is quite high, 80, 90, 95%, it means there's very little cushion should the net profits be less than what was expected, and that could reduce the likelihood that the dividend will be able to be paid. The other thing to look at is the type of business you're in. Let's compare someone selling chocolates versus someone selling automobiles. Well, we have seen through history that small consumer recurring purchases like chocolate, beverages, food, those tend to be made through thick or thin. People need to enjoy themselves as a low cost relative to people's nest egg or income. So the chocolate business is far more stable. There's less volatility in the income, less risk that there's a shortfall and dividends can't be paid out. Now look at the automobile business. Most automobiles purchases can be deferred generally, so that if there's a job loss, if the country is in a recession, the automobile industry is one where the earnings can really sink precipitously, which could cause the auto company to skip or reduce the dividend. So those are two ways, looking at the size of the payout relative to the income for the dividend, and look at the type of industry to see how safe that potential dividend might be. I'm actually now going to turn it over to Claire to answer a question of her choosing.
Okay. Here's a fun one. It's, I have a trust for my children. Should I be using stocks or bonds in that trust? First off, I think if the trust is for your children, you've got a very long-term horizon, probably 30 or 40 years beyond your own life expectancy. So to me, that argues for bonds or for stocks. I apologize, because that's going to grow higher over your child's entire life expectancy. And second, there's a trick with trusts and taxes. Trusts happen to have very compressed tax rates. So if the trusts are not currently distributing the income out to your children, they're going to pay, a trust will pay higher taxes faster than a human being will. Though again, would be paying 15 or 20% tax on dividends versus potentially 37% tax rate on bond interest at as low as $12,500 worth of income. So for trusts, particularly for long-term, I want to see those in equities. Your turn, David.
Yep. Thank you, Claire. So here's a great question, which is, how safe is U.S. credit in the future? And certainly it's a great question. Now we've seen the total U.S. debt surpass 20 trillion, and annual deficits approach 1 trillion. You wonder, how is all that debt going to be paid back? It's a good question. I think that the answer is that you're highly likely to have the return of your money, but what the purchasing power might be is really anyone's guess. Why am I so confident that you'll actually get the number of dollars you're entitled to? Quite simply, the printing press. The United States government, through the Federal Reserve, can essentially create out of thin air whatever money it needs. Now, there's still a political risk. We can do that, but there could be loggerheads in Washington, and we don't have the political will to do it to achieve some other political objectives. That would be a little bit like cutting off our nose to spite our face. So I think that the political risk can get passed, and we have the ability to give you your cash that you're owed. The question is, what can you buy with it? And that comes into the inflation risk. And if a country can only produce a fixed amount of goods and services, and you double the money in circulation, all things being equal, the purchasing power of the currency is going to be cut in half. And so I think that's the big risk with bonds, including U.S. credit, as to the inflation that could be occur between now and when you get your money back. Your turn, Claire.
Okay, next question. Should I keep stocks in my taxable account, or should I pay down my mortgage? And here's how to think about that. Say your mortgage rates right now are 4 to 4.5%. So if that's your mortgage rate, paying your mortgage down early is equivalent to earning that 4 to 4.5% rate of return on your money. So it's a math problem. Do you think you're going to do better with stocks in your taxable account than 4.5%? History would tell you yes, over the long term. The other practical piece of this is liquidity. If you've got a couple of $100,000 in your taxable account and a couple of $100,000 left to pay off your mortgage, as so long as the couple of $100,000 is in your taxable account, it's there for emergencies. If you take all that money and pay down your mortgage, and then something comes up and you need 40 or 50,000, it's a lot harder to get that money back from the bank. All of that said, we know that people are often anxious to get that mortgage paid down. What we recommend in this situation is just increase your monthly payment by a few $100s, some comfortable amount that will certainly pay off your mortgage more quickly. And you have the ability to turn that additional payment on and off as your own personal circumstances change. So that if you need a new roof or you need a new car or there's a big medical expense, you're not flat broke, and looking to establish a line of credit to pay the bill. Your turn, David.
Thank you, Claire. Now we have a great question from one member of our audience. Quote, it seems that an IRA with good quality stocks actually is better than putting the IRA in fixed income, particularly now given the low interest rates. And I think it raises two great issues. One is, what role do bonds play in an investor's asset allocation? And the second question is, what account do those bonds should they be in? Let's take the asset allocation. We all like to think that just putting all our money in good quality stocks will be the road to financial security. Financial history tells us otherwise, that periodically there are some very nasty sinking spells. Warren Buffett the other day at his annual conference said that since he's been in business, he's seen many times when his stock and stocks generally have gone down 50%. So, the problem is, do you have the staying power? Do you have the fortitude? And you can be sure once they're down 50%, people are going to say they're going down another 50%, that to hang in there. And of course, no one knows for sure, particularly given that stocks have done so well for so long that over the next 10 years, stocks will outperform bonds. We think that the odds favor that, but we can't be 100% sure. So I think there's still a case for having bonds as a portion of your asset allocation. So if we get past that, the question is, where should you put the bonds? And I think Claire, with her tax expertise, made a great case for not putting the bonds in your taxable account. You're taxed currently, you're taxed at higher rates. You don't have a chance to enjoy the lower tax rates that are applicable to long-term capital gains and to stock dividends. So therefore, we think to get the higher yielding aspect of taxable bonds, put those in the IRA. And so I think the answer is that you shouldn't probably have your IRA entirely in even the best so-called quality stocks out there. Thank you. Claire, your turn.
Okay. This will probably be our last one, and then we'll turn to the poll. And although this isn't quite an asset allocation question, it's a where do I keep my asset question, and it's one I see a lot. I still have a 401k at an old employer. Should I leave it there? Should I take it? What should I do with it? We always advocate rolling old employer retirement accounts into your IRA, and there are many reasons for that. One, the 401k where it sits has a limited menu of funds in which you can invest. With an IRA, you can invest in just about everything. If you like the funds your employer offered you, you can still invest in those funds, but you can invest in just about every stock and bond out there as well. And there are a couple of other practical reasons. One, your old employer really wants you to take that money. They don't want the job of tracking you down when you're 70 years old and making you take required minimum distributions. When you are 70 and a half and have to start taking those required distributions, if you have more than one 401k, each 401 or other employer retirement plan, each of those plans has its own required minimum distribution that you must take from that plan. So you may find yourself having to take minimum distributions from 4 or 5 different places. And finally, a lot of people just totally forget about their old 401ks, lose track of them, and that's giving money back to your employer. I don't see the point of that. So yes, when you leave a job, you should be rolling your 401k out to an IRA.
Great.
And let's see what people think about their retirement planning.
So let's go to the poll. Okay, so 60% of the respondents said they didn't think they were on track for retirement savings. Only 40% did. So, well, you know,
we want to talk to 60% of you.
Yeah, that's why we have a job. And we'd love to confirm the 40% who feel they are on track. In any event, we really appreciate the questions. We appreciate you tuning in. If there's any way we can be helpful, if there's more questions, if you'd like to sit down at some point, complimentary, please contact us. Again, thank you so much for your support here. And we wish you a great day and see you at our next webinar. Thank you.
Thank you so much. Bye-bye.